So if you've been watching the precious metals market, you know the last few days have been an absolutely brutal roller coaster, right? After a historic run-up, prices just suddenly fell off a cliff. Today, we're going to break down exactly what happened, why it happened, and most importantly, what it could mean for you. Okay, let's get right into it. To really put this into perspective, on Friday, January 31st, silver had its steepest single-day drop since 1980. It plunged an unbelievable 36% at its lowest point. Now, this wasn't just some minor dip. This was a market-shaking event that wiped out an estimated $15 trillion from the gold and silver markets. I mean, just to wrap your head around that, that's more than the entire annual GDP of China.
Okay, so this brings us to the two giant questions on every single investor's mind right now. First, what on earth caused such a violent crash? And second, looking at all this chaos, what is the right move to make? Well, in this explainer, we're going to tackle both of those head on.
Here's our game plan. First, we'll get a handle on just how big this plunge was. Then, we'll unpack the perfect storm of triggers that set it off. We'll also get into the bigger forces at play, like the dollar and interest rates. From there, we'll talk about whether it's time to panic, lay out a playbook for navigating this volatility, and then, finally, we'll zoom out and take a look at the long-term picture. All right, first up, let's just set the scene. Before this massive sell-off, both gold and silver had been on an absolute tear, hitting record highs one after another. So the reversal wasn't just big, it was sudden, and it was incredibly sharp. Let's just look at the raw numbers here, because they tell the story. Gold fell from a peak of over $5,600 an ounce down to $4,745. That's an 11% correction. But silver, whoa, silver was the real headline. It crashed from around $122 an ounce all the way down to just over $78. That is a staggering 36% drop. So you have to ask, how does a market fall that fast? Well, it wasn't just one thing. It was really a combination of three powerful triggers all hitting at the exact same time. Let's break them down one by one. The initial spark, the thing that really lit the fire, was a political move. President Trump's nomination for the next Federal Reserve chair, a guy named Kevin Warsh. Now, you might be wondering, why does one person's name have such a massive impact? It's because the Fed chair holds immense power over the economy, and the market saw this nomination as a huge signal, because Warsh is widely viewed as a monetary hawk. So what exactly is a monetary hawk? Well, to put it simply, it's someone who is much more likely to raise interest rates to keep inflation from getting out of control. To the market, this signaled a potential end to the era of easy money and super low interest rates, an era that had been a huge tailwind for gold and silver. So the key takeaway is this nomination changed everyone's expectations for the future, like overnight. Okay, trigger number 2 basically threw gasoline on the fire. The CME Group, which is the main commodities exchange, suddenly jacked up the margin requirements for trading gold and silver. Just think of it like this. It's like your bank suddenly calling you and demanding a much bigger down payment on a loan you already have. It just became way more expensive to hold on to your position. And here's what that actually looked like. For silver futures, the margin jumped from 11% up to 15%. Now, for traders who were using leverage, this meant they had to come up with more cash immediately. A lot of them just couldn't, which forced them to sell their positions to cover that margin call. And this forced selling pushed prices down, which, you guessed it, triggered even more margin calls. It created this absolutely devastating downward spiral. And the third and final factor, good old-fashioned human psychology. After such a massive run-up in prices, you had big institutional funds and everyday investors all sitting on huge profits. So once the sell-off really got going, the fear of losing all those gains kicked in hard, and a massive wave of profit-taking started. That's what turned a sharp drop into a full-blown crash. Okay, so those were the immediate triggers that lit the match. But to really understand what moves gold and silver, we need to look at the fuel that's always there in the background. And that's the two fundamental economic forces, interest rates and the value of the US dollar. Let's see how these really shape the market. Think about it this way. When interest rates are rising, your savings account or government bonds start paying you more. Gold and silver, on the other hand, they just sit there. They don't pay you any interest. So the opportunity cost, that's the interest you're giving up by holding a bar of metal instead of cash, it goes up. And that makes holding assets like gold and silver that don't produce any yield a little less attractive. Now, the second piece of this puzzle is the US dollar itself. See, gold and silver are priced in dollars all over the world. So when the dollar strengthens, it takes more euros or yen or whatever to buy 1 ounce of gold. This just makes it more expensive for foreign investors, which can reduce global demand and push the dollar price down. It's simple. If you're in Europe and the dollar gets stronger, that gold bar just got more expensive for you, so you might just buy less of it.
So we've seen the plunge and we get the reasons why it happened, which leads us, of course, to the most important question for anyone holding these assets. Is it time to panic?
Look, the impulse to just sell everything when you see a chart plunging like that is completely understandable. It's human nature. But reacting emotionally is almost always the single costliest mistake an investor can make. So let's try to shift from pure reaction to clear-headed strategy. Instead of hitting the panic button, let's build a simple, rational framework for how to think about this kind of volatility. It really all comes down to having a calm, strategic mindset. First, and this is absolutely crucial, you have to know your role. Are you a short-term trader trying to catch quick price swings, or are you a long-term investor using metals to preserve wealth? Your actions totally depend on that answer. Second, just take a breath. Emotional decisions are rarely good ones. Third, think back to your original goals. Why did you even buy this in the first place? If it was a long-term hedge, does a few days of wild swings really change that? For most people, the answer is no. And finally, focus on the big picture, not the daily noise. And this quote from an expert just captures that long-term mindset perfectly. Long-term investors see this market situation as an opportunity to purchase during price declines. It's so true. What a short-term trader sees as a total crisis, a long-term investor might actually see as a buying opportunity. It really is all about your perspective. So let's do that. Let's zoom out to that long-term view. Because despite this recent crash, a lot of experts are pointing to several powerful underlying trends that support precious metals over the long haul. These fundamentals haven't gone anywhere. We're seeing this global trend of de-dollarization, where central banks around the world are buying up gold. Precious metals are still a classic hedge against inflation and a safe haven during geopolitical turmoil. And for silver especially, there's a massive and growing industrial demand from green energy, electric vehicles, and electronics. These are deep-rooted trends that are not affected by one bad week of headlines.
So the crucial point is this. The real conversation isn't about the price on any given Tuesday. It's about the fundamental role that an asset like gold or silver plays as a long-term store of value and as a diversifier inside a balanced portfolio. And that leaves us with a final question, and it's one only you can answer for your own financial journey. When you look past the scary headlines and the fear, is a dramatic price drop like this a threat to your wealth, or is it a rare opportunity to build it? The answer really lies in your timeline and your strategy.